The role of central banks in economic stability. Introduction. Central banks play a crucial role in maintaining economic stability within a country. As the primary monetary authority, they oversee the money supply, interest rates, and financial systems to ensure a stable and healthy economy. Central banks, such as the Federal Reserve in the United States, the European Central Bank in the Eurozone, and the Bank of England in the United Kingdom, have wide-ranging responsibilities that directly affect inflation, employment, currency values, and overall economic growth. This article explores the essential roles of central banks in achieving economic stability and the tools they use to manage economic fluctuations. Number 1. The mandate of central banks. Primary goals. Central banks are typically mandated with promoting price stability, controlling inflation, full employment, and moderate long-term interest rates. Some central banks also focus on ensuring financial system stability and fostering conditions for economic growth. Independent institutions. Most central banks operate independently of political influence, which allows them to make decisions based on economic data rather than short-term political considerations. This independence is critical to maintaining credibility and ensuring that decisions are made with long-term economic stability in mind. Number 2. Controlling inflation. The core role of central banks. Inflation management. One of the central responsibilities of central banks is to control inflation. Inflation refers to the rise in the general price of goods and services in an economy over time. Central banks use various tools to keep inflation within a target range, typically around 2% in many advanced economies. Interest rates. The most common tool used to control inflation is the manipulation of interest rates. By raising interest rates, central banks can make borrowing more expensive, which reduces spending and slows inflation. Conversely, by lowering interest rates, they encourage borrowing and spending, helping to stimulate the economy during periods of low inflation or recession. Inflation expectations. Central banks also work to manage expectations about future inflation. If businesses and consumers expect prices to rise significantly, they may change their behavior, driving inflation further. Central banks aim to anchor inflation expectations through transparent communication and clear policy goals. Number 3. Promoting full employment. Dual mandate. In some countries, such as the United States, central banks have a dual mandate to ensure both price stability and full employment. Full employment refers to a situation where nearly all individuals who are willing and able to work can find employment and prevailing wage rates. Economic growth and employment. Central banks play a role in promoting economic growth by influencing aggregate demand through monetary policy. When the economy is struggling and unemployment is high, central banks can lower interest rates or increase the money supply to stimulate spending, investment, and job creation. Balancing inflation and employment. However, central banks face a delicate balancing act. Expanding the money supply too much in an effort to reduce unemployment can lead to inflation, while high interest rates to control inflation can worsen unemployment. Central banks must carefully assess economic conditions to maintain the right balance. Number 4. Financial system stability and regulation. Lender of last resort. Central banks are often referred to as the lender of last resort because they have the authority to provide emergency funds to financial institutions in trouble. In times of financial crisis or liquidity shortages, central banks can offer loans to banks or other financial institutions that are struggling, preventing the collapse of the financial system. Regulating banks and financial institutions. Central banks also regulate commercial banks and other financial institutions to ensure their solvency and proper functioning. By setting capital requirements, conducting stress tests, and overseeing lending practices, central banks aim to prevent excessive risk-taking and maintain trust in the financial system. Managing systemic risk. Central banks monitor the financial system for signs of systemic risk, which refers to risks that threaten the stability of the entire financial system. If large financial institutions fail, or if there is a widespread loss of confidence, it can have severe consequences for the economy. Central banks work to identify and mitigate these risks to maintain financial stability. Number 5. Managing the money supply. Monetary policy tools. Central banks control the money supply through various monetary policy tools, including open market operations, reserve requirements, and discount rates. By controlling the amount of money circulating in the economy, central banks influence inflation, interest rates, and overall economic activity. Open market operations. One of the primary tools used by central banks is open market operations, which involve the buying and selling of government securities. When a central bank buys securities, it injects money into the economy, stimulating spending. When it sells securities, it withdraws money from circulation, helping to control inflation. Reserve requirements. Central banks set reserve requirements which dictate the amount of money commercial banks must hold in reserve and not lend out. By adjusting these requirements, central banks can influence the amount of money in circulation and the level of credit in the economy. Number 6. Managing exchange rates and currency stability. Currency stability. Central banks also play a role in maintaining the stability of their country's currency. A stable currency fosters international trade, investment, and economic growth. Exchange rate fluctuations can lead to volatility in trade and investment, affecting economic stability. Intervention in foreign exchange markets. In certain situations, central banks may intervene in foreign exchange markets to stabilize their currency. They do this by buying or selling their own currency against other currencies. This intervention can help stabilize the value of the national currency and prevent excessive volatility. Currency pegs and monetary unions. Some countries maintain fixed exchange rates by pegging their currencies to another currency, such as the US dollar. Others, like members of the Eurozone, share a common currency, the euro, and rely on the European Central Bank to manage monetary policy for the entire region. Number 7. Stimulating economic growth during recessions. Counter-cyclical policy. During periods of economic downturn, central banks can stimulate growth by reducing interest rates or engaging in unconventional monetary policies, like quantitative easing. QE involves the central bank purchasing large quantities of government bonds or other assets to inject liquidity into the financial system. Lowering borrowing costs. By lowering interest rates, central banks make borrowing cheaper for businesses and consumers, which can lead to increased investment and consumer spending. This, in turn, stimulates economic growth and helps mitigate the negative effects of a recession. Quantitative easing. In cases where interest rates are already near zero, central banks may resort to quantitative easing to further stimulate the economy. By purchasing assets, the central bank increases the money supply, which lowers long-term interest rates and promotes lending. Number 8. Central bank communication and transparency. Forward guidance. Central banks use communication strategies to guide market expectations about future monetary policy. By providing clear and consistent messages about future actions, central banks can influence inflation expectations, consumer behavior, and investment decisions. Transparency and credibility. The effectiveness of central bank policies depends on their credibility. If businesses and consumers trust that the central bank will manage inflation and economic growth effectively, they are more likely to make decisions that align with the bank's goals. Transparency in decision-making processes helps maintain this trust. Regular reports and announcements. Most central banks publish regular reports, such as monetary policy statements, inflation forecasts, and economic outlooks, to keep the public informed. These reports provide valuable information that helps businesses, investors, and consumers make informed decisions. Number 9. The role of central banks in crisis management. Responding to financial crises. Central banks play a critical role in managing financial crises by providing liquidity, stabilizing markets, and coordinating with other financial institutions. For example, during the 2008 global financial crisis, central banks around the world took coordinated action to inject liquidity into the financial system and prevent a complete collapse of the banking system. Cooperation with other institutions. In times of crisis, central banks often cooperate with other national and international institutions, such as the International Monetary Fund, the World Bank, and governments to restore confidence in the financial system and support economic recovery. Preventing bank runs. By acting as a lender of last resort, central banks can prevent bank runs, where depositors rush to withdraw their funds due to fears of insolvency. Central bank intervention can reassure the public and maintain stability in the banking sector. Number 10. Central banks and the global economy. Global impact of central bank policies. Central bank decisions in major economies such as the US Federal Reserve and the European Central Bank have far-reaching consequences for the global economy. Interest rate changes, for example, can influence capital flows, exchange rates, and global trade patterns. Coordination between central banks. In times of global economic instability, central banks often coordinate their policies. For example, during the COVID-19 pandemic, central banks around the world took similar actions to lower interest rates and provide liquidity to support their economies. Global monetary policy trends. Central banks must consider the global economic environment when making policy decisions. The actions of one central bank can have spillover effects on other countries, which is why international cooperation is crucial for maintaining global economic stability. Number 11. Challenges faced by central banks. Low interest rates and limited effectiveness. In some cases, central banks face challenges in stimulating the economy when interest rates are already at historically low levels. With limited room to cut rates further, central banks may resort to unconventional monetary policies, such as quantitative easing, to achieve their objectives. Inflationary pressures. Central banks must balance economic growth with inflation control. Overstimulating the economy can lead to rising inflation, while being too conservative in monetary policy can result in stagnation and unemployment. Political pressure. While central banks are designed to operate independently, they are sometimes subject to political pressure. Political leaders may push central banks to lower interest rates to stimulate growth, even if it risks higher inflation in the long term. Number 12. The future of central banking. Digital currencies and central banks. Central banks are increasingly exploring the role of digital currencies. Digital currencies issued by central banks could provide an alternative to traditional banking systems and change how monetary policy is conducted. New policy tools. As the global economy evolves, central banks may develop new tools to address emerging challenges such as climate change, financial technology, and economic inequality. The future of central banking may involve greater emphasis on sustainability and social goals. Increased accountability and transparency. In response to demands for greater accountability, central banks are likely to continue enhancing their transparency and communication strategies. This will help ensure that their actions are understood and trusted by the public. Number 13. Conclusion. Central banks are integral to maintaining economic stability. By controlling inflation, managing employment, and ensuring financial system stability, they create the conditions necessary for sustainable economic growth. Through a combination of policy tools, including interest rate adjustments, monetary supply management, and crisis intervention, central banks guide economies through